Welcome to The Foundry, where leaders are forged daily. Each week we investigate themes of leadership, entrepreneurship, and mindset with some of the greatest minds in real estate. And now, the data scientist of real estate, George Roberts.
All right, welcome back, passionate investors. Today, I have the pleasure of interviewing Michael Parks, founder of the Navigator Wealth Fund, a custom private portfolio, not a pooled fund. Today, we'll cover a wealth of topics, including syndications, funds, and how to get started in real estate for you. But I have an announcement to make. So you'll notice that I changed the billboard of my show from Welcome Back Entrepreneurs to Welcome Back Passionate Investors. My first book, Passionate Living Through Passive Investing, is scheduled to be released around mid-September. This is a book that chronicles my journey from award-winning data scientist to private equity as a syndicator to my present life, where I'm focused on living life's adventure with remote work through real estate syndications as well as passive incomes. And now it's time to get to know our guest, Michael Parks. Welcome to the show, Michael.
Oh, hi, George. Thanks for having me.
All right. Well, it's definitely exciting to have you here because I know you've got a wealth of experience and can't wait to dive in with that. But first, I'd like to ask, when you're at a cocktail party and somebody asks you, what do you do? How do you answer the question?
I answer it with, I do real estate investing with my friends.
All right, great. And a great way to answer the question. So why don't you tell us how you do that? I know you've got a fund, and unlike a lot of funds where it's kind of a blind pool, you just go in and you say, hey, operator, go out and find these awesome investments and tell me about it later. Tell me how your custom portfolio approach works.
Yeah, so it's a hybrid between a fund, a traditional fund, as you noted, George, is usually you invest kind of like a mutual fund. You invest and then the fund manager deploys that capital to a variety of investments. And you get sort of the aggregate or average of that return across all those investments. Whereas a syndication, you invest specifically in one deal, right? Usually it's one property, although it could be a couple properties at once. They're identified up front. It's one, you know exactly where you're investing in, and that's really the only thing you're investing in. So a customizable fund takes the best of both worlds. So it allows investors to come into my fund and then choose within the fund which deals they want to deploy their capital into. So if they want to deploy into a value add apartment building in one case, and then they decide they want to invest maybe in a private loan, which I also put into my portfolio in the fund, but maybe they don't like this other deal that's something else. They choose how much money they want to put into each one of those deals. And then within our fund, we keep track of that and give them their returns based on the deals that they chose within the fund. Now, what's the advantage of that? From an investor standpoint, they're always getting, one set of updates from me and my partner, Jeremy Lemire, who run the fund, and they're getting 1K1 at the end of the year. And they can continue to move their money between investments. As they close out, they get their returns, they can move to new ones, all within one fund.
Yeah, those K1s got to smile because that's always a problem, it seems. K1 Blues. I've got to chat about that someplace. But anyway, just love to talk about the market and where we're at. We made it through a phase in real estate investing where it seems like just about everyone who threw their hat in the ring was reasonably successful. But with those interest rate hikes starting in the first quarter of 2022, I'd say we're definitely beyond that phase. The last leg, I think, is where all of the easy money was made. And so it's my observation that investors that continue to be successful in these more difficult times, they tend to have been successful in their previous life in some way. And I know, just talk a little bit about your background. You're an IT leader. You've also got a project management background and a bit of a Renaissance man. I see you also hold a patent. So can you tell us how these skills have served you in real estate?
Yeah, so I spent a good chunk of my early career out of college and was there actually for 18 years at Accenture. Accenture's a large, business IT consulting company. It really sits at the intersection between business and technology. And one of the reasons I stayed there so long is that one, I'm passionate about technology. I'm passionate about business results, and every project that we did was for large companies that needed to innovate or change in some way. And technology is just such a driver of change, really throughout all of our lives. So really love that, and love doing projects. I love seeing, outcomes happen, right? And that's the great thing about a project, is they always have an end. And when they end, you've accomplished something that you set out to do, ideally, right? That's your successful project. And
Yeah.
most of them are. I suppose they can end a different way too. So I have a great passion for project management and seeing projects get to completion and moving on and trying something new. And so, really, as I pivoted from Accenture, I started working at some real estate investment trusts with 30 billion in assets under management. And that's where I really learned kind of the big business of real estate and real estate investing versus just buying, let's say, a two-family or single-family house or something like that. Really get to see how you buy and manage and make bigger real estate an investable asset for people. And real estate's great because it's very project based. Whether it's a project where you're buying a building and you're going to be improving it in some way, doing some value add. Even if you're on the lending side, and I really like the lending side these days, every loan is its own project. It's its own thing to evaluate and potentially invest in and bring to completion. So I love being successful. I love moving from deal to deal, project to project, and so good project management skills, good management skills in general, leadership skills, all of those things that I really learned through my career, pivoting over and now running it as my own business.
Yeah, great. And very, I think very, very insightful, very important. I think we're definitely going to have to work a little harder now. But of course, as we record this, we look forward to hopefully our first rate cut in, gosh, I don't even know how long it's been since since the last rate cutting cycle.
It's been over
In
a
September,
year.
probably when this comes out.
Yeah, yeah. Yeah, so I mean, the market is interesting right now. I think this is what you're alluding to, obviously, is where we feel like the interest rates, and Chairman Powell just indicated, hopefully we've got inflation in the bag and we're going to start seeing some easing. So your point, right? The last several years with these rates going up has created challenges in the marketplace for borrowers, particularly borrowers that got into their properties in 2021, 2022, and did it on bridge debt, maybe did it on with short-term loans, some rate locks. Those things, as they're coming due, they're finding that the building may not be worth what they expected it to be, and if it is, it may not still be able to support the debt service, right? The debt service coverage ratio, when you put a 6, 7, 8% loan on something versus a 3.5, 4.5, 5% loan is significantly different. And so there's a need for dollars in to maintain those properties, or for them to continue to retain the properties into a new loan. So those dollars in, that's creating opportunity, or the need for dollars in is creating opportunity in mezzanine debt, opportunity in preferred equity, and quite frankly, opportunities to go buy property too. If that can't get figured out by the owner of the property, they have no choice but to move it to the marketplace. So I think we're going to see an opportunity here for deals. I think we're starting to see some of them where buying in equity positions can be at a better price than it was previously. And the other thing that I really like is the whole preferred equity, mezz debt, lending space. The returns are still pretty darn attractive, and the risk position is significantly lower than what you're going to see in an equity position. Because as you know, George, and I know much of your audience does, right? The debt gets paid before the equity. So now there's not the great big upside, but there's certainly less risk and still some pretty good returns. We're seeing 10, 12, 14%.
Yeah, I'm very glad that you mentioned debt, because I think debt it's great, especially when we see trouble on the real estate front, and we have seen when the rate shot up initially, we didn't have so many issues because the maturities of these loans really didn't necessarily coincide with the rate increases. But I think we've seen in 2024, if I'm not mistaken, significant rise in some distress sales, and we may even see some more even as rates begin to ease. Because, again, hey, if that loan comes due, it's really not an option. The bank, the lender is saying, you got to have something else new in place.
That's right. Yeah, and a lot of banks were deferring for a while, kind of right out of the pandemic. There was you know, some forgiveness to, move loans out, extend the terms a little bit, move it out another year. And that commercial debt that's coming due in 2024 is one of the largest we've seen in a long time because it's sort of piled up. And the other thing that happened, as you know, George, is that with the SoftBank and just banks getting into a poor liquidity position, that put a lot of tightness in the marketplace too. And so you got the lending environment, I don't want to say evaporated, but it got really challenging for a while. And, it's still challenging. And so that, again, when there's challenges, that creates opportunity. So
Absolutely challenging. They got mighty picky, as I would put it.
yes,
But yeah, if you can make
yes.
12% plus, that's great. And I think for a long time, that didn't maybe look so exciting to real estate investors if an equity position is promising 15% plus. But as for me, I really like the idea of being able to foreclose. I mean, even if you're in a mezzanine position, I mean, again, you're still getting paid before the equity investors. I'm sure there are going to be many deals where those mezzanine investors, they get their full payout, and a lot of these deals I think are going to be drained pretty dry. Equity investors may just be happy not to lose their capital in certain cases. So I would take a steady 12%. Even with inflation running a little hot, 12% is mighty fine. Double that money roughly every 6 years, assuming that you can reinvest it appropriately. But well, why don't we talk about private lending? First of all, I know that you, like most operators, you're working with people that have self-directed IRAs or solo 401ks. So, well, what's some of the benefits of doing private money through an IRA?
Yeah, so for sure. So investing in an IRA to these types of private placement memorandums and so forth, first of all, you have to be self-directed. You can't usually do that through your Fidelities of the world, and I'm sure your audience knows that. You have to have a plan that allows you to invest in these things called private placements or alternates, which is the types of things that we're talking about doing here. And so once you're into that position, one of the great things to get to your question is about lending. In an IRA, if you invest as an equity investor in a property, so you own a piece of the equity, and there is a loan on the property, and there's almost always a loan when you're talking about real estate. That loan gets attributed some amount of the income that the property makes, and from a tax perspective, it's UBIT, or unrelated business income tax. So you're making money, but you're making money not on your money, you're making money on the loaned money. And when it comes to this, investing with your IRA, and this is really the place it matters, is the IRA says, or the government says, your IRA needs to pay taxes on that unrelated business income tax. And you're going to say, wait a second, it's an IRA. I'm not supposed to pay taxes. Like, why am I paying taxes? I don't get it. That makes no sense. And so it gets complicated. It's not always like, don't ever do it. You could still do it, but you probably have to be investing enough money to make it worth your hassle. And you need to be that much pickier about the deals because your IRA is going to be paying money on that. So,
Yeah.
it's not to say never do it, but the great thing about lending, you don't have that issue. It just
Yeah.
it doesn't exist because you are a loan. Your IRA is making a loan. Your IRA is not an equity investor getting money from the loan or income from the loan's proceeds. You are making the loan directly. So no UBIT. If it's a 12% loan, your IRA gets 12%. That's it. Easy peasy.
Yeah, love it. In many ways, you can trigger that too. I know often, at least in the past, I've done pretty well with master limited partnerships and had a few 990Ts as a result of that. So, yeah, great tip. But then the other thing with private lending is you got to be really careful about the quality of the collateral, vetting the deal. Et cetera. I mean, of course, you're in a more powerful position as the lender, but again, you kind of have to, I think, put on maybe a different hat. Tell us about your criteria for being a debt investor.
Yeah, so for sure, a lot of it's similar to the way you would think about it as an equity investor with a few nuances. So just in general, you got to know who you're lending to. There's definitely stories of people borrowing money and running off to the Caymans or something, right? Like that happens. So if you're going to give somebody money, you need to know who you're dealing with. You need to get to know them. You need to check them out. You need to make sure that they've got the track record that you're comfortable with. And if it's not you, then you need to be working with a fund manager that does that on your behalf, which is what we do with the Navigator Wealth Fund, right? That's what I do. That's what my partner Jeremy does. And so people who don't have the time to do this type of vetting, they'll work with someone like us and try, and then we provide them the information and they make their own decisions. So certainly you got to know who you're working with. That's number one. And then, you got to make sure that the project that the money is going to is going to be able to pay the loan back. It's really easy to put a loan out there with you can put it out for 20% interest. Wow, that sounds great. Who wouldn't want 20% interest? But if the project can't pay it back, you'll never get it. You'll just wind up in court. So you do have to do a level of due diligence. And by the way, you wind up in court, and if the project isn't worth it, you don't get your money back. So you need to make sure that the project can support the interest payment that you're expecting to get from the loan, which means you have to do your underwriting as if you were an equity investor and make sure that there's income there. And then a couple of the key things that I would look at for a loan is the loan to value. And so if you think about the value of a property, let's say if it was a development project, maybe after development or ARV, after rehab value, right? The ultimate value of the project. And then you add up all of the debt that sits before you and then up through your debt of your loan. So if there's a first mortgage of, let's say, $5 million, and then you put another $1 million of debt behind that, that is like $6 million of debt to get you fully paid. And then maybe let's say there's 4 million in equity behind that and the whole thing's worth 10 million. Well, you're sitting at the $6 million of the 10 million mark, and that's a 60% loan to value. And that metric is the key metric that I look at when we're doing a loan, because you want to make sure that if things don't go well, if the property doesn't ends up costing more money, if the property is not worth what it was expected to be worth, and it has to get sold or liquidated in some way, you want to make sure you're up to 6 million is safe, because it's going to pay off that first mortgage at 5, and then your $1 million to get your capital back. You want to make sure that that's as safe as it can be. And so that loan to value ratio is a key metric. 60% is a very good place to be. We will go up into like 75% for the right opportunities. But more than that is a little riskier than we would want to get to. And you say, well, why wouldn't you just stay at 50%? Well, if you do that, a bank will probably do that loan. They'll do the loan at 6% interest. You're not getting 12% on your money if you're at a 50% loan to value. So you got to take a little bit more risk than, let's say, banks would, but then that's why you're getting an interest rate of 12% or something more significant.
Yeah, I definitely love private markets. Talk a lot about that in my book and private lending. I think it's very important. Yes, you have to differentiate yourself. If you're willing to do deals that the banks aren't willing to do, and I love your example because look, even if you have $5 million in front of you, if your $1 million still doesn't push you past 60% LTV, you might be in a very strong position to get that capital back. And yet you could be charging a much higher interest rate than the bank. Yeah, so I love your answer because you really talked about at least three of the C's in lending: character, that's who you're lending to; the collateral, right? Whether you actually have the appropriate collateral for the loan value, and cash flow. Yeah, also.
Yep.
Can they service that loan? I remember my first private loan, set it right in the contract that, you know, we're going to be paying every month. And the borrower was kind of surprised about that. Well, anyway, it was pandemic time, and so I had to show a little forbearance, at least with the timing. But got those payments because it was a good deal. So yeah, having the right deal, having the right collateral in place. One of the things I don't think you mentioned explicitly is draws. You did mention people taking the money and running off to the Cayman Islands. So providing the money in draws is a great way to make to circumvent that. Anything you want to add about putting the money out in draws, et cetera?
Yeah, no, I mean, obviously when you can do draws on a construction deal, you get an owner's rep in there to validate, you know, what's been done is what what's supposed to have been done for the money as you release it. Sure, there's some overhead to that. There's some cost to doing that. And so I would say that we've done that sometimes, and then at other times, we have not. And a lot of time we've more provided it as bills have come in. And that's usually ones where we're very close to the deal. We're probably involved with the deal. And so we have a lot of insight into how the money's being used. And that's one of the things that, there's kind of two kinds of, well, there's more than two, but there's two main kinds of funds out there. One is a fund that really can invest in anything, any syndication, any other fund. There's really no restrictions to it. It's called a 3C1 fund. We have a 3C5 fund, and on a 3C5 fund, we have to be involved and have influence over the project or the deal in some way. Now, when you're lending, just being the originator of the loan makes you involved, but most of our deals, we are involved in multiple ways, right? We're working we might be lending, but we might also be a general partner on the deal.
Yeah, great. And I'm glad you mentioned the involvement and the background, because I don't think you talked a whole lot about the project management background. Of course, this also gets into, the fact you are an IT leader, being able to really get into, I don't know, say get into the weeds of it all, but to really take control of a project, I think that's very valuable. And just wonder if you'd like to expound on that, your ability to go into, for example, construction issues, et cetera, because there's always issues. My family's in construction. I mean, does
Yeah.
anything get built and there isn't an issue with the city or with something that you found behind the walls, if it's redevelopment, et cetera? But would you like to go and expound on that a little?
Sure. I mean, I guess I would say, look, there's certainly a project management skill set. And one of those skill sets is just being able to track all the details, right? Have a plan, track the details, work the plan. But as you just said, plans never go 100% right, especially not in the details. So I think it's the experience of having been a project manager, doing large projects with whether they're up to $100 million or maybe even hundreds of people in some of my technology work. There's a lot of moving parts, and so what you can expect is the unexpected, and you can expect that things don't always go perfectly. And so I think a good project manager will cut through a lot of the noise, make sure they figure out what's really important, focus the team around what's important, make sure to dive into those details on those important items, whether the things that are going to drive critical path, the things that are going to drive the right NOI. When we're talking about real estate, how do you get rooms to unit to finished in order to create revenue? How do you make sure you're tweaking your rent revenue to balance both occupancy, but also getting a track record of rent that allows you to show value for a refinance or a sale? Like, there's a lot of those details, but really you can get lost in a lot of the noise very quickly, particularly in construction. There's so many things, little details around an HVAC system or fire blocking or like all of those things. And that's a tremendous skill set for people to have. And my partner, Jeremy, has a lot of that skill set, which is great, and which makes us a great partnership team. But for me, I try to keep everybody focused on, what's really important and is going to drive value.
Yeah, I love
And
it.
that's our
Critical
goal.
path, Gantt charts, all that good stuff. Seen you and Jeremy do that and want to make sure you really had an opportunity to get that story out there. All right, beautiful. Well, thank you so much. I look forward to releasing this episode. I appreciate you taking the time to share your knowledge and experience with our audience.
Thanks, George. Appreciate you having me on.